Welcome to another edition of Pizz-Spectives. My name is Pizzichetta, founder of Mont Wealth, and today I'm very excited because we're going to be talking about the new frontier of investing, talking all things digital assets with Jamie Hanna, Head of Investment Strategy at VanEck's. Welcome, Jamie.
Thanks very much for having me, Rob.
I'm excited about this conversation today. Obviously, we know what we're going to talk about, digital assets, and it's a bit of a buzz at the moment. There's a bit of volatility around as well at the same time. But before I do get into it, I'm going to highlight the general advice disclaimer. Anything that Jamie and I discuss today is general advice only. Anyone acting on this advice without written and agreed consent does so entirely at their own risk. So again, Jamie, thank you very much. So talk a little bit about how you got to VanEck, your role there, and your views on digital assets right now.
Yeah, look, I've been in the finance industry for around 25 years now. I spent more than 10 years working inside the investment banks in London and New York, and a lot of experience in Australia. So I'm very much a traditional asset investor. At the moment at VanEck, I'm managing essentially just under $28 billion worth of assets. I'm the deputy head of investment. So essentially my day-to-day role is running around about 46 investment funds that primarily invest in your traditional assets, equity share funds. We're talking bond funds. We're talking some commodity funds. So what you would otherwise term as like traditional assets. So from that point of view, I'm very much a traditional asset person. It's still my day-to-day job. But in terms of digital assets, it's become a bit of a specialty. It's become a new asset class for us. And it's another avenue for investors. And as we have a Bitcoin fund, if I give you a little bit of history on that, I really had no involvement with crypto assets before about 2019. I know they'd been around for many years before that, but I'd very much stayed out of it. The firm in the US, VanEck in the US, started looking into digital assets around 2017. We applied for the very first spot Bitcoin ETF in the US in 2018, but obviously that was rejected back then. And it was shortly after that, around 2019, that I was tasked to start looking at digital assets as a whole, Bitcoin, and how it could work in the Australian environment. So I really got introduced through our US office, through our European colleagues, to a lot of people in their digital and crypto asset fields. And realistically, over the last 5 years, I've essentially met a lot of people, structured new products, and really learned a lot about how the digital assets work.
Now, if I could take you back to 2018, 2019, when you took on the responsibility of doing the work, no doubt a bit like me probably a few years ago, there was skepticism. So what were some of the things that were on your mind that bothered you as a traditional investment analyst to say, hey, maybe there's nothing here, or this is what I need to prove to give myself more confidence to invest in digital assets?
Yeah, look, I wanted to understand how it worked on the back end. So I was fully aware that you could go and buy Bitcoin through an app or through a platform, however you wanted to get it, and all these other types of crypto assets. But arguably what was really going on behind it and who was behind it and who were the players that actually regulated, if there was any regulation, that was really where I was focused. And I think from my point of view, it took a while. This wasn't something that I was just straight away, oh, let's just buy these digital assets. I really wanted to understand it. And like it or not, one of the things that really became apparent is that a lot of the people behind the crypto platforms, behind the digital assets, a lot of them are actually ex-investment bankers. A lot of people were ex-traders at Goldman Sachs, managing directors at JP Morgan. So the reason why I think we're all talking about digital assets now is the fact that all of these institutional grade people jumped out of their normal traditional asset role and started working in the digital asset space. And what they've done, and they've brought a lot of their compliance, their regulation, their operational knowledge, and their marketing to this whole entire sphere of digital assets. And as a result, the world started talking about it as things started becoming more institutionalized on the back end, rather than just being a straight kind of, technical field for IT related people. So a lot of that where people are like, oh, you've got to buy Bitcoin to avoid the governments and all the banks and all this stuff. Actually, the people behind it are a lot of the same people. So don't feel like you're avoiding it. But actually, the reason why we're all talking about it now is because of that. So that was a big learning point for me. And hence, a lot of the controls and everything that I started to learn, there's a lot of overlap between that and a normal traditional asset.
Yeah. And I suppose also over the last 5 years, a lot of things have changed. You said institutionalized, but there's also been a lot of regulation that's come in. I know that Trump's enacted the Genius Act, which really supports the view on digital assets and obviously stablecoins and how that's tied to treasuries and the dollar. So that has given you a little bit of confidence as well that this could be a real asset.
Definitely. Look, I think the US are leading the charge at the moment. Obviously, President Trump is making quite bold calls in terms of that front, and that's really having a knock-on effect to the rest of the world. But if we actually think just locally here in Australia, in 2020, when ASIC were first developing their policy, I had some meetings with them. And one of the first questions they asked me was, how do you know if you buy a Bitcoin that you're not buying from or someone who you shouldn't be trading against? So look, things have come a long way from there in Australia. The policy framework has essentially been laid on how we can run a fund over that. And things are slow but progressive here in Australia. But arguably, what happens in the US is really the primary driver for all jurisdictions around the world.
Okay, fantastic. All right, so let's take a step back now. Let's discuss exactly what Bitcoin is and how it works and why it could be the new form of money and transactions. I'll hand it over to you.
Bitcoin is really just an electronic cash system that's not created or controlled by a country, right? That's all it really is. Coin in itself has a limited supply. There's only ever going to be 21 million Bitcoins. It's immutable, and that means that it cannot change. So once the blockchain is set, it can't be retrospectively changed in the past. And arguably, it's very secure because the whole ledger is freely available to anyone and everyone. And so anyone can see any of the wallets and the holdings. So from that perspective, it is just exactly what it says on the tin, electronic cash system, but it isn't. I don't see it as being a digital gold or anything like that. I think it is only what you can basically believe and see what it is in person.
So you believe it's going to be more so of a digital cash play in the money, internet money in effect, used for transactions?
It can be used for transactions, right? It is a substitute for your normal fiat currency. However, no one is going and buying their coffee with it. No one's going and spending some money to buy things with it on a day-to-day basis. The odd person around the world is legitimately using it to buy assets like houses, but it's not the norm. But it can be used for all of the above. So it is a substitute for fiat currency. And to be honest, Bitcoin is extremely liquid. It's one of the most liquid assets in the world at the moment. But people are talking about everything in relation to it. What else is it? Is it an inflationary hedge? Maybe, but it's too early to say that Bitcoin is a hedge to the price of things in our society that move. So maybe it's too early to tell. What it does do is it gives diversification to a portfolio, right? And so if you think about all the general assets, you might hold international shares, you might hold Australian shares, you might hold some bonds, you might hold a bit of gold and infrastructure. They're all different asset classes and they all move slightly differently. And Bitcoin is a diversifier because what it does is it's not correlated to these other asset classes. So it moves differently to how other assets move. And hence it can add diversification to a portfolio. But I honestly think without doubt, at the moment, Bitcoin is more of a momentum asset. So it's really driven by supply and demand. And at the moment, a lot of people are focused on it. There's a lot of turnover every single day in Bitcoin. And announcements come out from the US government, as we just spoke about, and it can move the price of it quite sharply. So it is a momentum asset more than anything else.
So it's quite volatile, momentum asset.
Absolutely.
Yeah. And so at what point do you believe then we go beyond it being a speculative momentum asset to an industrial asset regulated and part of society?
It's hard to say. If you look now at what the US is starting to do, they're implementing the legislation to make it part of essentially their central bank holdings. Once central banks start holding Bitcoin as part of their country's reserve, then you could make a case that potentially it is then a legitimized asset because it's being held by central banks around the world as some form of safekeeping for the country's assets. That's playing out now. We're seeing a lot of regulation, as you've already touched on, and that is making it safer to invest in. It's adding in a lot of controls and it's making it a better environment. And they're also seeing crackdown on illegitimate players, rogue countries, rogue people, operating within it all. We're seeing less of that as KYC and a lot of the regulation comes through. So it started. I don't think it's completely there. There are still a lot of unscrupulous players in the market, but the way things are progressing, you can't argue that it's going in the right direction.
Got it. All right. So you spoke about safer. It's a decentralized transfer of money in effect. So it bypasses the banks whenever you trade between yourselves, right? So I can go straight to you to buy or sell a car or whatever it might be. That's the way. But how do I trust the process? You spoke about Ledger earlier. How does it actually trade, and how do we know that it's actually going to be able to transfer that Bitcoin from myself to yourself?
That is to do with the blockchain. That is purely blockchain technology. So if we think about how, say, Bitcoin, and we're going to focus on Bitcoin here, works, is that it's just a blockchain ledger. And so anytime there's a transaction from one wallet to another, what actually happens there is that the message is created to transfer one Bitcoin from my wallet to yours, Rob. The details are put in. But then to actually change the blockchain itself, the transaction is put out to what we call Bitcoin miners, but actually they're nodes in the network. And they have to solve a really complicated cryptological puzzle. So the person who solves that puzzle first gets to settle the transaction on the blockchain, and then they will then update the blockchain, and then it gets sent out to everyone around the world. It's quite a secure process because there are a lot of different parties involved in this. There are a lot of Bitcoin miners opting to try and win the ability to do it, because once you win and settle the transaction on the blockchain, you actually receive Bitcoin in reward for doing that. It's unlikely to be hacked. It's unlikely to be gamed in any great way. It really is just a database in a ledger that is updated for the whole world to see at all times.
Okay. And so let's talk about the VBTC, which is the ETF that can buy into the Bitcoin. How am I confident that if I were to buy it, how is it different to me just buying via the wallet itself?
So let's start with a few things, right? The number one difference, and it's potentially a negative for VBTC, I'll start with the negative, is that Bitcoin is available 24/7 to anyone who wants to trade it. If you buy VBTC, you can only trade it during the ASX trading hours, which is roughly 10 o'clock to 4 o'clock, Monday to Friday. That's a given. That is the one downside to buying VBTC or any Bitcoin ETF. But I think the pros certainly outweigh it. So if we look at some of them, VBTC gives you access to the spot price of Bitcoin while the market's open. So it's essentially holding Bitcoin as the underlying asset of the fund. And I can touch on more on that later. But the reason why you'd want to do it is it's a regulated vehicle. So we, VanEck, we are regulated. So if anything ever happened, there is actually recourse against us from our AFSL licensing to all of our frameworks that we have in place. So there is a real company behind this. We obviously try to make this the most effective investment possible in Bitcoin. So we have secure custody, which is cold storage, and I can talk more on that later. But I think one of the key things that people don't really understand is that when you go and buy Bitcoin yourself, one, you can only buy it through one platform. So you have to set up an account with one of the Bitcoin platforms, and then you can go and buy your Bitcoin directly through them. What people don't fully understand is the full cost implications of doing that. One, you need an account, first of all. Second, to settle the transaction, you're going to pay commissions, right, to the platform, and some of them are big. You're going to pay a spread on exchange. That's the difference between the bid and the ask, like you would on a share. There are transfer fees, there are network fees. And the one hidden cost that people don't think about is a lot of these transactions settle in US dollars. And the rate you get from Aussie dollars to US dollars on a lot of these is expensive. So you can easily pay a couple of % away when you're buying Bitcoin yourself. And, if you wrap that all up, but some people aren't really noticing because Bitcoin is quite volatile. It feels like it's moving a lot, but you're actually paying that. Whereas if you buy that through the ETF, you have the annual management fee, which just leaks out every day. You don't actually physically pay that. But second of all, you'll only pay your brokerage and the spread on the screen like you would with a normal share. So they're the only fees. It's very much tied in. And we can execute the Bitcoin at super tight rates compared to anything you'd be able to. But then I think taking all that into consideration, one of the main things is that actually secure custody. And I'm sure we'll talk on that again shortly.
Yeah, well, then let's talk about it. So how do you ensure that my ETF Bitcoin that I buy off the platform is safe via the VanEck ETF?
Yep. The key is really cold storage. Now, if you're an individual purchaser, let's think back like what you did before. What if you went to a platform? You'd have to keep the private key yourself, and you run the risk of either losing or having it stolen or hacked from you. And you've heard all the stories about people who had Bitcoin and they lost their key and then they can't find it. If you do lose it, it is gone. There is no way to actually get it back. If it's stolen, it's extraordinarily hard to get back. So if you keep the key yourself, then all the risk sits with you. It's like essentially keeping a gold bar at home. If you have a login to a system, that means that you have a password and you log in and your online platform will store it for you. That's open to hacking quite easily. They can hack your password, they can hack into the system, and you run the real risk of actually getting hit by a hacker and losing your assets. That is a real risk. With cold storage, we employ institutional grade custodians, and your underlying key is stored offline, completely separate to the internet in a physical location. So nobody can remotely log in and hack into it because it's not connected to the internet. Now, to access this location, you'd have to know where it is. But even if you could gain access to this location, you wouldn't have the individual key to access the holding. Now, nobody had this individual key in these custodians. In the case of one custodian, they split up the key into various little shards, and then various employees around the world are given one small piece of it, but they don't know who has it. So these organizations have hundreds of employees around the world, and only certain ones will have access to the key, and no one knows which one has it. So unless you had every single employee in the whole world, you wouldn't be able to assemble it even if you access the physical location. So this cold storage is really the critical element to this institutional grade custody of the assets. And look, it's essentially how they keep the nuclear codes. Is there a way to hack it? It hasn't been hacked. It would be extraordinarily difficult. I mean, in fact, I'd probably say beyond that, but it's as safe as we can possibly keep the assets. Now, I just want to touch briefly. The assets have to come out of cold storage for any change of the wallets if we're buying or selling Bitcoin. So it then moves into what's called a hot wallet. Now, most individuals will only ever have it in a hot wallet, but we have to move small portions out to transact on any given day. So the only bet that's really at risk are the bets that's coming in and out on any given day, which is based on the trading activity at the time.
Now, talking about trading activity, do you have a view on how much of it is actually retail or institutional or speculative? Do you have a view on that?
So you're talking in Australia? Then in Australia, I'll talk Australian first. I'm sure you probably know globally. In Australia, it is very much retail money. It is, I would dare say, in the ETF itself, it is practically no institutional grade investors in Australia. We see a lot of platforms, we see a lot of brokers, we see a lot of online brokers as well. But for the most case, most of it is unadvised. So the actual individual has decided to buy it. What you will find is a lot of advisors are restricted and can't recommend it. So it's very much at the discretion of the investor to make that decision to buy some. And that's what we've generally seen in Australia. In the US, it's a completely different story. They have well over $100 billion US dollars worth of assets in Bitcoin ETFs. It's been a huge take up by institutional investors across the board. The flows have been absolutely phenomenal. And realistically, while I can't tell you exactly where it's all coming from, so numbers aren't known, institutions have been buying it in a big way. Will it ever happen in Australia? I don't know. I feel like there are options offshore because Bitcoin is primarily a USD asset. However, all things said and done, Australia's probably a fair bit behind the US in terms of institutional investment.
So why do you think the US is so far ahead?
One, it's regulated there, and it's always been the hub for global capital. You only have to look at the size of their share market. They're over 50% of the global market, just on the share market, for example. Australia's like 1 to 2%. We've always been, while Australia's big, we have a huge superannuation market and these huge pools of money. We've never attracted huge amounts of offshore capital. It's really congregated around the New Yorks and the Londons of the world. And it's arguable that just Bitcoin and digital assets are the same. It's nothing against Australia. We're just a smaller economy in a smaller part of the world. And that's all it really is.
Yeah. I saw recently some headlines that Square is now accepting Bitcoin. You can tap your Apple wallet or wallet to then transact. I also saw over the weekend that JP Morgan is allowing Ethereum and Bitcoin as collateral if you want to go and borrow money. So you can see that the institutions in the US are moving fast and they're adopting the technology. Just on that adoption, have you got a view on stable coins, and does that kind of validate this whole digital asset sphere?
Look, stable coins are an interesting concept because they are actually backed by an asset, right? When you're looking at Bitcoin, there's nothing behind it. There's no company. There's no government. It's an individual asset on its own. Whereas tokenization and stable coins have actually, in most cases, US Treasury sitting behind it. So for every dollar of stable coin you buy, there's a dollar worth of, a US Treasury bill. So it's inevitably safer and has a backing. So it's probably the way things are going. It cuts out a lot of intermediary banks. It makes payment systems a lot more, I guess, easier to manage, but it will obviously increase the amount of treasuries that are starting to be purchased if it really starts taking off. So I think tokenization, really, we're going to see a lot more of it. We're going to see a lot more stablecoin issuance, but fundamentally while they run on blockchain technology, they're two different assets in the same class.
Got it. So yeah, another way of looking at digital assets and a second derivative of it is potentially the infrastructure that supports it. Do you have a view on the infrastructure of digital assets?
But the infrastructure is, in my mind, a bit of a problem. There is no centralized exchange, right? So when you're buying Bitcoin, it's only what in professional talk, you'd say it's just an OTC transaction, which means over the counter. If you're buying shares, you go on to the ASX and you can go and buy shares. If you can go and buy them in the US through the New York Stock Exchange, right? You're buying through a regulated vehicle. Here, you are actually just agreeing a trade completely separate to any centralized exchange when you're doing it. So because there's no centralization on the Bitcoin blockchain, there's no centralization of the actual exchange. Everyone is operating similarly, but all differently at the same time. So I feel like the infrastructure has a bit of a way to go. If you take all the flows that take place, they're probably happening in about 10 main exchanges, take the vast majority of all the flows, but there's more than 100. And to be fair, some of those 100, when you start getting around the bottom, there's some really dodgy ones, right? So there's still a long way to go in terms of improving the infrastructure and imploring that there's a standardized Bitcoin price, because there isn't. When people quote the price of Bitcoin, for example, they're actually taking the price from like maybe 5 or 10 exchanges that are all trading it, and it's just an average price between them all. So there isn't standardizations that you get in a normal asset class at the moment.
So we've spoken about the speculation that Bitcoin is and was, potentially could still be, how it's converted itself into an institutional asset class, given what's going on in the US. It's regulated, but what are some of the risks that we should really be mindful of still for Bitcoin?
Look, I think you're buying an asset that has nothing backing it up for Bitcoin. If it's true, there's no government or company or physical asset behind it. So there's still an absolute risk in comparison to other asset classes. Bitcoin is purely priced on whatever an investor is willing to pay. It doesn't actually have an intrinsic value. That is arguably the number one issue that a lot of people have had with Bitcoin, and why people are being hesitant to invest in it. It's why it's taken so long to become an asset class. And so it's still the underlying risk. It's not going away because it's not ubiquitous across the market that people are just spending it in their day-to-day lives. So it's still the number one risk. There's still the risk that potentially someone could overthrow the whole blockchain in some way, maybe quantum computing. I hear all these questions all the time. No one really knows if quantum computing can overturn it. So there are risks here. You're really buying something that doesn't have anything underlying it. However, if you look at it and what it's been doing, it's been around since 2009. It's become more regulated in terms of how it operates. There's opportunities. And look, if anyone had held Bitcoin long term, you're probably wealthy beyond measure, but it has been super volatile. It's just something that I feel there is some FOMO there. People are worried about missing out. But having said that, it's a diverse portfolio. So you've got to accept the risk when investing in Bitcoin and understand that it's an emerging asset class.
Yeah. And now when you present to other investment committees that are considering Bitcoin and digital assets, their portfolio, what kind of allocation are we discussing here to put forward?
Oh, tiny. We're talking 1% or less. People are just, in terms of actual offering advice, it's difficult. There's AFSL requirements and the understanding of it. So what you're finding is not a lot of advisors have yet put it in their models. So it's very much new. But what you'll find is so many advisors are getting questions on it. They can answer questions, but they've been struggling to make recommendations to put bits in their portfolio. So this is a new dynamic. This is changing. If you look at some of that history, if you go back 5 or 10 years that you had a 1% allocation of Bitcoin in your portfolio, and the numbers are quite staggering, really. I'm not saying it's going to do that in the future, but I think so. What you need to weigh up is people are going to start recommending it, and they're going to be small allocations, as I said, tiny, but a lot of people have already taken the onus on themselves and started to invest in it separate to their advisors.
Yeah. And given you noted earlier, it seems like it's an uncorrelated investment to a lot of the other asset classes. So for you, this would sit in an alternative sleeve of the portfolio.
Yes, it does fit in the alternate sleeve. Some people look at it differently, but yeah, alternatives is sometimes infrastructure, gold, physical, some other commodities. That's generally maybe private credit, private equity, depends on the advisor. So yeah, it very much fits in the alternative bucket. It certainly should not make up a core part of anyone's portfolio.
I agree with that. So for those that are looking at investing in the VBTC, which is the ETF, the way I look at it, it's a set and forget. It's one of those ones where, as you say, potentially 1% of the portfolio, you allocate it to the portfolio, and it's not really there for transactions. It's not there for speculation. It's just there for the long-term growth potential that this has as a result of central banks buying it, institutionalized, being regulated, and more of an adoption to the asset class. Is that fair?
That's exactly fair to say. Yes.
Yeah, great. Now, finally, for those listeners that want to learn more about VanEck and the other investment opportunities they've got, Jamie, where can they go to learn more?
Oh, straight onto our website, www.vanecks.com.au.
Fantastic. I know there's some good reading on there, so I do recommend going to the website and having a look. Jamie, thank you so much for your time. And again, anyone that was listening in today, this is general advice only. Anyone acting on this advice does so entirely at their own risk. So thank you again, Jamie.
Thanks, Rob. Appreciate it.